All right, so we're gonna take a deep dive into this ebook you shared with me, The Raw Truth of Algorithmic Trading.
Okay.
Now, I gotta say, the term algorithmic trading, I kind of think of like some like sci-fi movie, right?
Right.
Wall Street, like robots taking over.
Yeah,
But I think our goals here today is to kind of demythify that
definitely.
and see how it really like impacts, the average person, even if they're not a, Wall Street hotshot or whatever.
Yeah, I think that's a great way to put it. The reality is that algorithmic trading is, it's not about, robots taking over the world.
Yeah.
It's more about, leveraging technology to make smarter trading decisions.
Okay, so less Hollywood, more like real world practicality.
Exactly.
But I think before we get into the nitty-gritty, I think it's important to define like what are we even talking about here? Like
Yeah.
what is algorithmic trading?
Yeah, that's a great question. I think at its core, algorithmic trading is really just using computer programs or algorithms to automate trading decisions. But it's very important to remember that it's based on data, not emotions.
Okay.
So instead of relying on gut feelings, which can be unreliable, algorithms are going to process information and execute trades according to a set of predefined rules.
So you're saying it's like having a super powered trading assistant
Right.
working around the clock, but one that doesn't like panic sell when the market gets a little jittery.
Exactly. And that brings us to, I think, one of the key advantages of algorithmic trading, and that's speed and efficiency. So machines can analyze massive amounts of data and execute trades in milliseconds, something that's, impossible for us as humans to do.
Yeah, that's some serious speed.
Right.
I guess it makes sense if you're trying to capitalize on like, fleeting
So
opportunities in the market. Every millisecond counts, I would imagine.
absolutely. And beyond feed, there's the advantage of taking the emotion out of it.
Okay.
We as humans, we're prone to making irrational
For
decisions,
sure.
especially, based on fear and greed.
Yeah.
But algorithms, they're going to stick to the plan no matter what's happening in
Wow.
the market.
That's a huge advantage, I think, especially for somebody like me who gets, caught up in the hype or the panic of the moment.
Right.
So I can see how like taking emotion out of it
Exact.
could lead to more consistent results.
It certainly can, but it's important to remember, these algorithms are still created by humans.
Yeah.
So it's not a foolproof system.
Right. So there's still human error that can kind of creep into the process, even with all this, this fancy technology.
Right.
But I guess assuming like the strategy is sound, how do these algorithms like actually, put it into action? What are some of the game plans they use?
Yeah, I think that's where it gets really interesting. There are several key strategies that algorithms can use, each with their own strengths and weaknesses.
Okay.
But let's start with trend following.
Okay.
These algorithms, they identify and ride the wave of rising or falling prices. They use indicators like moving averages to pinpoint buy and sell signals.
So it's like surfing, but with market trends instead of wave.
You got it.
You're trying to, catch that upward momentum, ride it for as long as possible.
Right.
But I imagine there's risk,
Oh, absolutely.
like wiping out if the trend reverses.
Yeah, exactly. That's the biggest challenge with trend following strategies. They can be very effective in strong, sustained trends, but they're susceptible to sudden reversals.
Yeah.
So you need to know when to ride the wave and when to jump off before it crashes.
Okay, that makes sense.
Yeah.
So, what about a strategy that's not about riding the wave, but more about betting on things returning to normal?
Right. So that's where mean reversion strategies come in.
Okay.
They operate on the principle that prices tend to revert to their average over time.
Okay.
So if a price spikes or tips significantly, these algorithms wager on it, eventually returning to its historical mean.
So kind of like a pendulum swinging back and forth.
That's a good way to visualize it.
Okay.
However, there's a catch.
Uh-oh.
What if that average itself is shifted?
Oh, I see.
What if the market is fundamentally changed
Okay.
and the old mean is no longer relevant?
Right.
That's the risk with mean reversion strategies.
So you need to make sure that the normal you're betting on is actually still the norm.
Exactly.
Okay, so what other kind of tricks do these algorithms have up their sleeve?
Well, how about profiting from tiny price differences between markets?
Okay.
It's called arbitrage.
Arbitrage.
For example, back in the early days of algorithmic trading, there's a famous case where an algorithm exploited a price difference between the S&P 500 index on two different exchanges and made a huge profit in a matter of seconds.
Wow, so they found like a loophole in the system
Yeah, exactly.
and capitalized on it before anyone else noticed.
Right.
But I imagine those opportunities are pretty pretty rare.
You're absolutely right.
And fleeting.
As more players enter the algorithmic trading game, these price discrepancies, they tend to vanish quickly. And as technology gets more sophisticated, the algorithms themselves are getting better at spotting and exploiting these opportunities.
Right. So it's like an arms race
Yeah,
to find those title edges
it is.
before they disappear.
Exactly.
Okay, so we've got trend following, mean reversion, arbitrage.
Right.
What about a strategy where you're not necessarily betting on a particular direction,
Right.
but rather like providing a service to the market?
So that's where market making comes in. It's kind
Okay.
of like being the casino in the world of trading.
Interesting.
Market makers, they provide liquidity by placing both buy and sell orders continuously, and they profit from the spreads between those orders.
So they're always willing to buy or sell to kind of keep the market flowing smoothly for everyone else.
Exactly, but it's not without risks.
Okay.
In very volatile markets where prices can swing wildly, market makers can get caught on the wrong side of a trade and suffer substantial losses.
So it's like walking a tightrope.
It
You
is.
got to constantly be adjusting to keep your balance.
You got it.
Okay, so next strategy,
Correct.
high-frequency trading. That's the one that seems to always grab the headlines.
Right. High-frequency trading, or HFT, it's all about speed.
Yeah.
These algorithms execute trades at incredibly high speed, often taking advantage of tiny price fluctuations that occur in fractions of a second.
So this is like the Formula One of trading,
It is.
where every millisecond counts.
Every millisecond counts.
But I know there's a lot of controversy surrounding HFT.
That is.
Can you talk about that a little bit?
Yeah, so HFT is often criticized for its potential to exacerbate market volatility and for creating an uneven playing field where only those with the fastest technology can compete. And there's a lot of debate about whether it actually benefits the market as a whole
Okay.
or simply creates more risk and instability.
It sounds like a pretty complex issue
It is.
with no easy answers.
It is.
Okay, we've covered a lot of ground here, but there's one more strategy I'm kind of curious about.
Sure.
Statistical arbitrage.
Right. Statistical arbitrage, or stat arb as it's often called.
Okay.
It relies on complex mathematical models to identify mispriced assets.
So it's like data mining
Yeah, you could think of it that way.
for investment opportunities?
Yeah, like finding hidden gems in the market based on data patterns that others might miss.
Okay.
But stat arb is highly sensitive to the accuracy of its underlying models.
I see.
So if the assumptions are wrong or the data is flawed, the strategy can backfire spectacularly.
So high risk, high reward.
Exactly.
And really dependent on the quality of the data.
Very much so.
And the model itself. It seems like algorithmic trading, no matter what strategy you're using, requires a pretty solid understanding of both, the technology and the market dynamics.
Absolutely. Each of these strategies has its own strengths and weaknesses, and choosing the right one or a combination of strategies depends on your risk tolerance, your understanding of the market, and your technical capabilities.
Right, that makes sense. But I gotta admit, like this is all sounding pretty technical to me.
Right.
I'm starting to wonder, like, do I need to be a coding whiz
Yeah,
to even consider getting involved with algorithmic trading?
that's a common misconception.
Okay.
While coding skills can definitely be advantageous,
Yeah.
there are options available for traders of all technical backgrounds.
Okay. That's good to know.
In fact, there are platforms designed specifically for those who prefer a more user-friendly approach.
So you're saying there are options for people like me
Absolutely.
who aren't exactly coding experts?
Yes.
Okay. So what are some of those options?
So there are no-code and low-code platforms
Okay.
that offer pre-built algorithms
Interesting.
and very intuitive interfaces.
So no code trading algorithms.
Yeah, it's pretty amazing. You can set up and execute trading strategies without writing a single line of code.
That sounds almost too good to be true.
Right.
But I imagine there are limitations, right?
Of course, the main trade-off is customization.
Okay.
You're limited to the features and strategies provided by the platform.
I see.
It's like building with a pre-assembled Lego set.
Right.
You can create something cool,
Yeah.
but you can't deviate from the instructions.
Got it. So what if you do want more control?
Right.
And the ability to customize your strategies?
Well, if you're comfortable with programming languages like Python, you can build your own custom algorithms on platforms like ThinkScript or MQL5.
So then it's like having like a blank canvas
Exactly.
and a box full of Lego bricks. You can kind of build whatever you can imagine.
You got it.
But I'm guessing there are downsides to this as well.
Absolutely.
Right.
The biggest one is the potential for coding errors.
Oh, okay.
A single mistake in your code can have significant financial consequences, so thorough testing and debugging are absolutely crucial.
Right, because it's like building a skyscraper,
It is.
One misplaced blick can bring the whole thing down.
Exactly.
So finding that That right balance between ease of use
Right.
and customization is key.
Precisely. Choose tools that match your skill level and risk tolerance.
Okay.
If you're just starting out, a no-code platform might be a good way to just kind of dip your toes in the water.
Uh,
But if you're looking for maximum flexibility and control, learning to code might be a worthwhile investment.
so it's about using the right tool for the job,
Exactly.
understanding the trade-offs involved.
You got it.
But no matter what, no matter which path you choose, I imagine there's still like inherent risks in algorithmic trading.
You are absolutely right. Algorithmic trading isn't a magic bullet. There are plenty of potential pitfalls to watch out for.
Okay.
And that's what we're going to explore next. We'll delve into the dark side of algorithmic trading, the things that can go wrong, even with the best designed strategies.
All right, let's uncover those potential pitfalls.
Let's do it.
I'm a little nervous now, but let's do it.
Okay.
So we've talked about how powerful algorithmic trading can be, but like any powerful tool, it's important to understand like the potential downsides.
Right. You got to know how to use it responsibly.
Yeah, exactly. So let's start with one of the biggest pitfalls. Overfitting. Now, I gotta say, I'm not a data scientist, so
Sure.
break that down for us. What does that even mean in the context of algorithmic trading?
Okay, imagine you're, a musician
Okay.
and you've been practicing a song like over and over again in your studio.
Yeah.
You nail every note, every nuance, and it sounds perfect.
Right.
But then, you go to perform it live in front of an audience.
Yeah.
And it falls apart.
Oh
The
no.
different acoustics, the energy of the crowd, all these unexpected distractions throw you off.
Yeah.
That's kind of similar to what can happen with overfitting and algorithmic trading.
Okay, so the algorithm gets I guess, too comfortable with the data it's trained on.
Right.
It becomes a master of like, past patterns, but then when it's faced with like the unpredictable nature of the real market,
Exactly.
it kind of falls apart.
Yeah, an overfit algorithm might look brilliant in backtests, performing flawlessly on historical data, but when it encounters new market conditions,
Yeah.
it can crumble like a house of cards.
I see. So it's almost like if you trained like a chess AI on games played only by beginners, right?
Right.
It might beat them every time.
Exactly.
But then against a grandmaster, it would be toast.
Exactly. It'd be hopelessly lost.
Okay, so how do you avoid this overfitting trap?
Well, it's all about finding the right balance
Okay.
between optimizing for past performance and making sure that the algorithm is adaptable to future unknowns. It's like, think about it like training for a marathon.
Okay.
You don't just run on a treadmill, right?
Right.
You vary your terrain, you practice in bad weather conditions.
Right, you got to be ready for anything.
Exactly. You got to push yourself beyond your comfort zone.
So you're preparing for the unexpected. You're making sure your algorithm can handle, whatever the market throws at it.
Exactly.
But overfitting isn't the only challenge, right?
Right.
What about like execution issues? Those
Yeah.
real world limitations that can, trip up even the most sophisticated algorithm.
You're right. Execution issues are crucial to consider. One common problem is slippage.
Okay, that's it.
That's when you place an order at a certain price, but due to market movements or delays in execution, you end up getting a worse price than expected.
I see.
Think of it like trying to snag tickets to a sold-out concert. You might see a ticket available at face value, but by the time you click buy, the price has gone up or the ticket's gone.
Yeah, the frustration of online ticketing.
Exactly.
Even though the algorithms are super fast, like you're saying, these tiny little delays
Right.
can still eat into your profits, especially in high frequency trading where, fractions of a second matter.
Absolutely. And then there's latency, which refers to the time it takes for your orders to travel from your computer to the exchange and back. It's like playing an online video game with a laggy internet connection. Your actions are delayed.
Yeah.
You might miss your shot.
Oh, I know that feeling all too well.
Right. It can be the difference between a profitable trade and a missed opportunity.
Absolutely.
And then there's the unpredictable behavior of brokers.
Okay.
Sometimes orders get rejected or filled incorrectly due to technical glitches or even human error on the broker's side.
So it's not just about having the smart algorithm, it's also about like
Right.
the infrastructure around it.
Absolutely. Having a reliable infrastructure and a trustworthy broker.
Yeah, so what other execution issues should we be aware of?
Well, another thing to consider is the impact of unexpected news or events.
Okay.
Algorithms are designed to react to market data,
Yeah.
but they can't always anticipate black swan events.
Right.
Those unpredictable occurrences that can send, shockwaves through the financial system.
Right, like a natural disaster or a sudden political upheaval or something like that.
Exactly. Those are the kinds of things that can throw even the most well-calibrated algorithm, of course.
It seems like you need to be constantly vigilant, even when you have an algorithm doing the heavy lifting.
You do. You absolutely do. And on top of all these execution challenges, there's the ever-changing nature of market conditions themselves.
Okay, so let's talk about that. How do changing market conditions impact algorithm trading?
Well, the truth is, markets are constantly evolving.
Right.
What works in a bull market might fail miserably in a bear market. An algorithm that thrives on momentum during a period of growth might crash and burn when market sentiment turns sour.
Yeah, it's like having a wardrobe full of summer clothes
Uh,
and then suddenly winter arrives.
exactly. You're caught unprepared.
You're not
You
ready.
got to be ready to adapt your algorithmic wardrobe, so to speak, to the changing seasons of the market.
Right, right. So you're like a fashion designer. You got to constantly be like, updating your collection
Yeah,
to stay ahead of the trends.
exactly.
But speaking of market volatility, let's talk about, those flash crashes, those
Right.
sudden dramatic drops in asset prices that we often hear about. How do they connect to algorithmic trading?
Flash crashes are a fascinating phenomenon, and they often highlight the interconnectedness of the algorithmic trading world. Imagine a scenario where multiple algorithms, all designed to sell when prices drop below a certain threshold, are triggered simultaneously.
Okay.
They all start selling,
Yeah.
pushing prices down further, triggering even more algorithms to sell, and it just creates this downward spiral.
So it's like a chain reaction.
It is.
One algorithm's actions trigger a cascade of selling across the entire market.
That's a good way to visualize it, and it's one of the reasons why flash crashes can happen so quickly,
Yeah.
with such intensity.
It's kind of unnerving to think about, to be honest.
I understand, but it's important to remember that regulators are constantly working to understand these risks and mitigate them.
Okay.
They're developing new rules and safeguards to prevent these flash crashes and to ensure the stability of the financial system.
That's reassuring. So
Yeah,
it's like a constant game of cat and mouse between the people pushing the boundaries of
right.
of algorithmic trading
It is.
and the people trying to, keep the system stable.
Absolutely. And that brings us to, the ever-evolving landscape of regulations,
Right.
which adds another layer of complexity to the mix.
Okay, so let's talk about regulations. How do they impact algorithmic trading? I imagine it's pretty challenging to keep up with the rules when, technology is advancing so rapidly.
It definitely is a challenge. The rules governing algorithmic trading are constantly changing as regulators try to keep pace with these rapid advancements in technology.
Yeah.
What might be legal today could be banned tomorrow.
Wow.
So it's crucial for traders to stay informed and adapt their strategies accordingly.
It's like playing a game where the rule book is constantly being like updated.
Yeah, exactly.
You got to be on your toes,
Yeah,
ready to adjust your game plan at any moment.
absolutely.
So I guess that's why it's so important to have a strong understanding of, the legal and ethical implications of all this.
Yes, it's not just about making money.
Right.
It's about operating responsibly
Yeah.
within the bounds of the law.
At the end of the day, we want a financial system that's fair
Right.
and transparent. That benefits everyone, not just the people with, the fastest algorithms.
Exactly. So as we've seen, there are many potential pitfalls in the world of algorithmic trading.
Yeah.
But these challenges shouldn't discourage us.
Right.
They should motivate us to learn, adapt, and strive to use this powerful technology responsibly.
Okay.
And speaking of the future, let's shift gears and explore what lies ahead for algorithmic trading. What's next? Are we all going to be replaced by robots?
That is the question that everyone is asking. What does this all mean for the future of trading? I mean, are we all just going to be like obsolete in the face of these like super fast, super smart trading algorithms?
Well, that's a question that sparks a lot of debate, but it's true. AI and automation are definitely changing the landscape of finance, but I believe the future of trading is really going to be more of a collaboration
Okay.
between humans and machines.
Okay, so it's not like robots versus humans.
Right.
It's more like a partnership where each one kind of complements the other.
Exactly.
Okay, I like that. But I mean, what would that actually look like in practice?
Well, imagine a world where you have human traders, and they set the overall strategy,
Okay.
define the risk parameters, and provide that, big picture vision.
Okay.
Then you have the AI-powered algorithms, and they handle the execution, constantly learning and adapting to market changes in real time.
So the human intuition and experience is kind of working hand in hand
Right?
with the speed and efficiency of the machines.
Exactly.
Okay, so that's a pretty powerful combination.
It is.
But you mentioned AI and machine learning. So how are those technologies already shaping the future of algorithmic trading?
Well, they're being used to develop algorithms that can analyze vast amount of data, identify complex patterns, and make predictions with increasing accuracy. We're even seeing the emergence of self-learning algorithms that can adapt to changing market conditions without human intervention.
So it's like the algorithm is constantly like evolving,
Right,
improving, learning from its mistakes,
right,
getting smarter over time.
exactly.
But wouldn't that create a situation where like the algorithms become too powerful,
That's a valid concern.
too autonomous? Like who's keeping them in check?
Well, that's why even with the most sophisticated AI, human oversight is still absolutely crucial.
Okay,
We need to ensure that these algorithms are operating within ethical and legal boundaries
right.
and that they're aligned with our overall goals. Think of it like, self-driving cars.
Okay.
They can handle most situations, but you still need a human driver behind the wheel, ready to take control if necessary.
Right, so you got to maintain that balance between automation and human control.
Exactly.
Okay. So beyond AI, what other trends are shaping the future of algorithmic trading?
Well, one exciting trend is the rise of cloud-based trading platforms,
Okay.
making powerful tools and data accessible to a wider audience.
I see.
Instead of having to invest in expensive hardware and software, traders can now access sophisticated platforms and data from anywhere with an internet connection.
So it's kind of like it's democratizing access
It is.
to these
Yeah,
tools, making algorithmic trading more accessible to, individuals and smaller players.
exactly.
But I imagine with increased accessibility
Right.
comes increased complexity.
You hit the nail on the head.
Right.
Managing a cloud-based trading infrastructure requires a different skill set compared to traditional trading setups.
Yeah, it's like having a powerful new car
Right?
with all the latest features.
Exactly.
You still need to know how to drive it
You do.
effectively and safely.
Absolutely.
Like there's a learning curve there.
There is.
Okay, so beyond the cloud, what other developments are making algorithmic trading more accessible?
Well, another trend that's breaking down barriers is the rise of open APIs.
Okay.
So APIs, they're like pre-built building blocks that allow you to connect different software applications and leverage existing functionalities.
So they're making it easier for anyone to connect to financial markets, access data, develop their own trading applications.
Exactly. It's opening up a world of possibilities for
Right.
those who want to experiment and innovate.
Okay, so that's pretty exciting.
It is.
But with this increased accessibility also comes, increased competition, right? As more players enter the game,
Absolutely.
it becomes even more crucial to develop unique strategies and stay ahead of the curve.
It does. If everyone has access to the same tools and data,
Yeah.
it's really the creativity and ingenuity of the human trader
Right.
that will make the difference.
That's what's gonna set them apart.
Exactly.
And we can't talk about the future of algorithmic trading without mentioning DeFi bots, right?
Right. DeFi
They're
bots.
they're revolutionizing the world of decentralized finance.
Absolutely, which operates outside the traditional control of banks and institutions.
DeFi bots, that's intriguing. Tell me more.
Well, DeFi bots are essentially automated programs that interact with these decentralized platforms, and they enable a whole new range of trading and investment opportunities.
So it's like the Wild West of finance.
It is.
Where the rules are still being written
Exactly.
and the potential for both innovation and disruption is immense.
It is.
Okay, it sounds like a high risk, high reward frontier.
For sure.
But with all this talk of robots and AI and
Right.
decentralized finance, I can't help but wonder where does this leave the human trader?
Right.
Is there still a role for us in this increasingly automated world?
Absolutely. I believe the future belongs to those who can bridge the gap between technology and human expertise.
Okay.
Those who can leverage the power of algorithms
Yeah,
while maintaining the critical thinking,
right.
the intuition, the adaptability.
That are, yeah, uniquely human. So
Exactly.
it's not about like resisting the tide of technology. It's about, learning to ride the wave,
It is.
embracing the tool that can actually enhance our
Oh,
capabilities
absolutely.
and allow us to, navigate this evolving landscape. That's a powerful message.
It brings us back to, knowledge is power.
Right.
Whether you choose to actively engage in algorithmic trading or not, I think understanding its implications is really vital in today's financial world.
It's like, even if you're just watching the game from the sidelines, you still need to understand the rules.
You do.
Right.
Absolutely.
That knowledge allows you to make more informed decisions.
Exactly.
No matter your level of involvement.
Right.
So, for those who are intrigued, who want to delve deeper,
Yeah.
what would you tell them?
I would say, embrace your curiosity. Don't be intimidated by the jargon or the technical complexity.
Yeah.
Start with what sparks your interest
Okay.
and gradually build your knowledge base.
So take it one step at a time.
Exactly.
Learn the basics and then explore the areas that kind of resonate with you.
Exactly. There are tons of resources available online, from introductory articles to comprehensive courses catering to all levels of experience. And, don't be afraid to experiment. There are platforms out there that will let you test out trading strategies in simulated environments so you can get a feel for how things work without risking real money.
That's a great way to get your feet wet,
Yeah,
before you dive into the deep end.
absolutely.
But algorithmic trading is not a solo sport, is it?
It's not. There are vibrant online communities of traders, developers, enthusiasts who share their knowledge, their insights, even their code. Connect with others, ask questions, learn from their experiences. It's a great way to avoid common pitfalls and really accelerate your learning curve.
It's about finding your tribe, right?
It is.
In this new digital frontier, sharing knowledge, supporting each other,
Absolutely.
and always remembering that even with the most sophisticated algorithms, continuous learning, adaptability, and a healthy dose of skepticism are pretty crucial.
I couldn't agree more. Don't fall for get-rich-quick schemes or promises of guaranteed returns. Algorithmic trading can be a powerful tool,
Yeah,
but it's not a magic wand.
right.
It takes effort, it takes discipline,
Yeah.
and a willingness to constantly learn and adapt.
And remember, the journey itself can be just as rewarding as the destination.
Absolutely.
Well said. I think that's a perfect note to end on. We've covered a lot of ground today, exploring the mechanics of algorithmic trading, the potential pitfalls, and the exciting possibilities that lie ahead. So
It has been a fascinating conversation.
yeah, I really appreciate you taking the time to break all this down for us.
It was my pleasure.
And to our listeners, thanks for joining us on this deep dive into the world of algorithmic trading. We hope you found it informative
Yeah,
and thought-provoking.
definitely.
And remember, the world of finance is constantly evolving, and knowledge is your most valuable asset. So stay curious, stay informed, and never stop exploring.
Couldn't have said it better myself.
Until next time.
See ya.